And joining me tonight on the panel is Christopher Joy, an AFR columnist and a YBR Funds Management Director, and we have Matthew Kidman, who is an ex-funds manager, and he's a columnist with the Fairfax publications, and he's done an array of publications outside of the Fairfax group. Gentlemen, welcome. How are you?
I'm good.
You're rushed. It's the Sydney traffic. It's been crazy.
Oh, it was bumper to bumper.
Yeah, I know. I tried to get onto the bridge and I think, oh, this isn't going to happen again. And there was a big bus just stopped in front of me. I thought, oh, how will I explain this? 3 empty seats.
Well, I went to India 2 weeks ago and I feel very relaxed about the traffic.
Oh, really? It's no rickshaws anywhere. That's right. In India, what was it like? What was your... I mean, I'm assuming you're holidaying, but in terms of... You know, we hear about the different economies that are driving the world forward. Do you feel confident about India?
In some ways. India is the land of the contradiction. It's very old, but it's a new democracy. It's dirty outside, the houses are clean inside. There's a lot of things to weigh up, but it's slowly getting to where it's going to go. And the way I see it from an economic point of view is it will be one of the large economies of the world for many, many years just because of the size and because they want to succeed, but it's never going to be a world leader.
You know, it's an interesting thing, and we're going to move on to India now, so we didn't plan for this, but I remember reading something about with Mark Latham when he was popular.
Yep.
He was talking about the Indian experience in terms of the graft and corruption around the structure of it, in that if you showed to be very popular in terms of economically, you'd done well as a person in your business, then somebody would come and say, look, I need to get some money, and so they would limit their popularity or limit their economic growth because of the natural structure. Do you think the governments have started to move away from that and been able to change and liberate the economy of India?
Well, there's a big concern that India is... it's got a lot of corruption, and that's the handbrake on it. I would say it's a little bit of corruption and a little bit about how the system works, which we're not used to. So they've got English law, you know, they've got property rights, which we all understand here in Australia. But there is a lot of discretion about how business should be done. So classic is for the person on the street, you get into the cab, like a lot of places in Asia and Africa and other developing countries, and there's a meter. But they don't use it.
No.
You negotiate the outcome. So a lot of Westerners, Australians, Europeans, Americans, think that that means you've got to give kickbacks and you've got to... There's corruption. But I think it's a bit of a mixture of, yes, there is corruption like there is anywhere, and business is done a different way. It's not that efficient. They need to get more efficient.
And we're in New South Wales, and we can talk about corruption. It could take 4 hours for a show, so let's not move down that one. Equity markets rally, bond markets rally, the world at large is rallying. You know, Chris, what's your take on it in terms of how does it look 3 months down the track? I see CBA got sold off today a little bit. There's rotations. What's your thoughts in markets in general at the moment?
I think that as long as we have this mass money printing and quantitative easing that we've talked about on the show before, I think the outlook for risk asset classes like equities and housing particularly is very, very good, and I can't see that ending. You know, one of the most amazing statistics I saw this week was that Switzerland's central bank has invested 15% of its balance sheet in direct shares across 1,200 companies. So this is a central bank buying equities. Japan's doing the same. In fact, apparently 1 in 10 central banks are now buying equities. So we have governments deliberately interfering with private markets and trying to set or influence asset prices. So, you know, it's a greater fool theory, and I think we're going to see this equities market run for a while yet. I think it's obviously also interestingly been good for bonds because we're seeing a kind of risk-on bond rally. But I think when the worm eventually turns and when this money printing stops, you'll see a big increase in bond yields, which will obviously be bad for traditional fixed-rate debt.
And your take on this market at the moment?
Well, equities market, which I understand a bit better than the fixed interest market, I've said that I think our market can go to 5,600. They always ask you, that's the end of the year, but somewhere this year I think we can go there, driven by exactly the themes you're saying. I think fixed interest is probably still continuing to rally, or at least stay firm. There's not going to be... But I think it's going to be a crowded trade. Look, we run through themes in markets. The theme at the moment is chase yield, interest rates are low, they're going to be low for a long, long time. And themes last and create, you know, too much money in one place. You know, we call them bubbles. But they can go for an awful long time. I think we're on that journey, but I think at some stage it's going to be quite nasty the way it's heading.
It's certainly got it's got the capacity to be volatile when it comes back, and I think the idea of the great rotation we've spoken about, where we say that it's the rotation out of the term deposits into the different asset classes, because the last 3 years, 2008, 2009, you've been great returns in term deposits.
I don't think that started, really. I think there's been money from, and Chris probably got a stronger view or a clearer view, I think there's been money from high net worths that of seeking more risk going into equity markets and so on. But I think the average term deposit holder hasn't really made that move. And the reason I say that is because I don't think a lot of money's gone into the equity market. To get money into the equity market, you need things like new issues and so on. At the moment, people, sure, there's more buying, selling, pushing prices up, but people are also selling. There's actually not a lot of money being taken up in the equity market. And I think that will drive the next leg. Like, people will want that
we often think, and I have no, it's just anecdotal, I'd have no numbers to back it up, but we think that the buyers of the four majors and Telstra have been the people moving out of those term deposits. Certainly at FIIG, we have a conversation around, do I buy Telstra, do I buy the four majors, or can you give me a fixed income alternative, or a floating, or an alternative? And it seems that everyone wants to buy Telstra. It goes through $5 this week. If you looked at the chart on Telstra, it looks like a race car. And I don't know that they'll come back that quickly, but I'm unsure that the money is going to BHP and Rios, and I don't know that the money's moving out. And so, in terms of the way, when I read in the paper, we're going to revalue banks, how do you think you should... we have a Telstra chart. Look at that. I mean, that's just...
magic.
Yeah, that is magic. You're only Telstra. In terms of... when I read in the paper, we're going to value banks differently. That was in the Fin Review 2 or 3 days ago. Does that make you nervous, Chris?
I think the banks are in a very interesting sweet spot right now. I wrote a column for the Financial Review a few weeks ago where I showed that the four major banks, extraordinarily, are leveraged between 60 and 80 times their hard capital against their home loan books. And so they have hundreds of billions of dollars of home loans, and they're holding typically only $1 to $2 of capital for every $100 they lend. And the four majors are generating returns on equity of somewhere between 40 and 60%. Now, the reason they're able to do this is that regulators here in Australia are permitting currently them to be leveraged 60 to 80 times. I think that's going to change.
That's against home loans.
Yeah, against home loans.
Yeah.
The true leverage is about 26.5 times across all forms of debt. But here's the rub for bank valuations. They're currently pumping out high ROEs. I think that's yesterday's story. I think in a nutshell, you will see the banks holding more capital, less leverage. I think there'll be less of a discrepancy between the smaller regional banks and the major banks in terms of how much they can leverage up. The regional banks hold typically half the leverage of the majors, which is extraordinary, and that's why they can't compete. They can't generate the ROEs. And I think that means going forward, growth will be much slower, and that will pose a medium-term headwind for bank valuations and returns. But right now, we're in a sweet spot because this will take years, I think, to make changes to.
Would that be your interpretation as well?
I get to the same point, but a slightly different conclusion. I totally agree. We're going to value them differently in the future. We already are. CommBank is getting towards...
$117 billion company.
That's right, and it's great, and it's a fantastic company. It's outperformed NAB. It's got...
It's the same size as Intel.
That's right.
Amazingly.
So, amazingly, and it's it's book value, which is another measurement. It's PE. They're right up at the upper end of where they have been historically.
Yeah.
But they've been forgotten for the moment. But just on that capital issue, you're right. The banks are accumulating capital. They don't need as much to lend out to for their home loans, which is ironic given what happened in 2008. And also, there's just not as much growth in the system. And so they don't need the capital.
Yeah.
So I kind of get to the conclusion that ROEs might come down a bit. And when APRA allows them, and we've seen a little bit of it this week with the results, the next 12 to 18 months, I think the only thing that the banks can do is pay more dividends.
That's right. And they know that. Now, hang on, we will talk...
under this current scenario.
We love dividends, and all the viewers love dividends, but we'll have to go to a break. So we'll have a short break, but please give us a call on 1300 30 34 35. When we come back, we will be talking about dividends, and you can email us. The email is yourmoney@skynews.com.au, and we'll be right back.
Everyone hopes for a future where you can afford the life you want. But it's not enough to hope for the best. You need to prepare for all market conditions. BT's new capital protection solution can help to protect your super and investments if markets fall, so you can invest with confidence at all times. Prepare for the best. Speak to your financial advisor or a specialist from BT today.
And the cat with the bass and drum going around like bum bum bum. What's grooving? I'm moving. I like your style of lumping. How charming, just a rapper. Load him up and put that snapper. I'm so cool and I'm so groovy. When I go bum bum bum. I'm so cool and I'm so groovy. When I go bum bum bum.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined on the panel by Chris Joy. Chris is an AFR columnist and a YBR Funds Management Director, and I've got Matthew Kidman, an ex-fund manager and a columnist with the Fairfax Publications. And they're here to answer any of your questions, so give us a call on 1300 30 34 or email yourmoney@skynews.com.au. Before we went to the break, we were talking about dividends and the bank dividends, and that's, I mean, the viewers love the dividend. Everyone loves the dividend story of the four majors. I think one of the things that I've been aware of, and haven't got it from them directly, the management of the banks know they've made that pact with the devil. And the devil is, I promise to pay these dividends, you promise to put my share price where it is. That seems to be the scenario. So they know they've got to be bedded into it, and when you see Westpac saying we might buy the shares back, even though they're very expensive, we'll buy the shares back, we'll give you extra dividends, you can see it playing out that dividends will drive this investor appetite for quite a while forward. Is that a good policy, or is that, would you agree that dividends are going to be driven by these banks and they'll be able to pay it out, or do you think they'll be forced to keep some of this capital in?
I mean, the short answer is I think investors are confusing debt and equity. They're trying to get debt-style income from equity risk, and I think the key thing viewers need to understand is that in the medium term, so over the next 5 to 10 years, the banks will need to build up their capital. That means lower dividends and fewer buybacks, because they're going to have to significantly reduce leverage, because it's totally unsustainable and it doesn't comply with the new global banking rules. So if you want that security of income, stick to fixed income. And if you want growth and the volatility and risk associated with equity-style exposures, that's the place to be.
And I suppose it's a combination of both. Your interpretation of the bank dividends going forward and over the next few years?
Yeah, we had a bit of a discussion in the break saying that the regulator won't necessarily allow the big banks in particular, who don't have to hold that much capital at the moment, against especially their mortgages, they won't let them pay out as much as they could or they would like. And I think that's the story in the next 12 months. Listening to Chris, though, I think he's right, that they're not applying enough capital to what they're lending out, and that will have to be stored up over time. One thing we've got to remember is equities are not bonds, and we're getting confused, and that is the theme that is going right around the world. Now, you talked about who are buying and who's getting blamed for all the buying of the banks and Telstra and so on, and the super fund owner, the self-managed super fund, has copped a lot of that blame, but it's become very, very obvious that the big move in the last 6 months is from foreign institutions who are looking for yield. They've come to Australia and they said, we can't believe you pay out such big dividends. We want a piece of that.
And can I just add, I think for viewers, again, what's happened around the world is that there has been so much new money created. That money has bid away the yield on debt, on bonds, in concert with the reduction in interest rates to near zero levels. So traditional income investors are moving into equities, searching for that yield, and that's why I think we're seeing so much momentum behind the market.
I mean, I couldn't agree more. I talk to funds, and the assets they used to buy are gone. So a leveraged loan book. He said, I can't even find any of these. So at this point in time, I might as well go and buy CVA, borrow as much as I can at the lower interest rate, and take the CVA dividend. And that seems to make a lot of sense. So how much would you like to do? Well, I'd like to do 200 million. Whoops. I mean, they like to buy a lot of this stuff because the effect of the leverage, so it becomes so dramatic on our share market.
Let's take a step down one, which is still a great company, Amcor, industrial company. Its register has gone from 30% foreign owned to 50% in the last 18 months. And the reason is it pays out a dividend of around 5%. So it's a classic story. It's just not the big banks in Telstra.
Is that a point of concern? I mean, we see everyone talks about the effect of the Aussie. The high Aussie compared to the other currencies, and we are aware of people buying the sovereigns of Australia. Do you think that's a point of concern in terms of trying to manage the inflows?
I think what the foreign investor has come to the conclusion is that they think that the Aussie dollar might be a bit more stable. They were always worried about it.
Yep.
Coming here, that it had raced up, that it was strong. Do we want to get caught in it?
70.
Now they're kind of thinking, well, that's not the risk we thought it was. You know, it might stay up around this parity level, and we're prepared to take the risk and get the yield. I mean, sure, some of them will hedge it out and take a cut on the yield, costing that. But I think that's been a big change, and funnily enough, it will change the other way just as quickly when a dynamic changes, and that money will race out. The foreign investor is always the most aggressive in and out, so just be careful about that.
The most liquid. And your interpretation of that,
I think there's silver linings in the clouds, twofold. Firstly, the high dollar is forcing companies to be much more productive and compete much more aggressively. Secondly, it means that we've got a wave of capital coming into this country, and hopefully that liberates more issuance, more debt and equity, and more opportunities for mums and dads to tap the big end of town.
Speaking of issuance, you and I were talking about this through the week. Do you want to talk to the viewers about what a lower Tier 2 asset is in terms of the capital and what's happened over the last month or so in terms of the price pressure?
Yeah, and I think this is just a good example of what Mark and I see in the wholesale markets that you don't read much about in the media, and so it really is the domain of the big end of town. But ANZ in December issued a subordinated bond. All that means, it's called a lower Tier 2 bond, all that means is that bond ranks in priority behind ANZ senior bonds and behind its deposits. They issued that bond at a price of 2.2% over the bill rate, and that was in December, so a few months ago. Today, people think that bond should only cost about 1.2% above the bill rate. So there's been a 100 basis point or 1 percentage point fall in the price of that bond. And the reason, it's fascinating, and this bond I've been watching very closely, it's increasing in price every single day, or the cost is falling every single day. And it is, I think, a very good manifestation of this desperate search for yield we're seeing in the institutional investor land, where folks are just running for anything they can find. And it just so happens these riskier subordinated bonds pay higher yields, but people bidding up that price is defraying that yield.
Yeah, they just want to get it.
Well, on the international scene, you've seen what, slightly different, but Apple and Microsoft's been able to raise debt at.
Billions.
It's quite remarkable.
And as soon as they've raised that debt, the market has rallied straight away. They issue 18 billion, and it's at $1, or I think it's worth $1.20. Straight away in the grey market before it even listed, they were paying up for that.
Right.
So it's quite a phenomenal movement at the moment in terms of both these asset classes moving in the same direction, and we'll talk about it after the break about QE3. Now, but we are about to go to a break, and I'm going to talk to you about Speaker's Corner, Chris. So we'll leave it here, but before we do that, you're going to have 30 seconds to talk about your Speaker's Corner, whatever you'd like to chat about. Time starts now.
Thanks, Mark. So the thing that I guess is really interesting me right now is this money printing phenomenon, and what we're seeing, so everybody understands, is taxpayer-owned banks, so the central banks that set monetary policy and interest rates. They started buying government bonds, they've moved into corporate bonds, and as I mentioned earlier, they're now buying direct shares. This is more or less unprecedented, it's never happened before, and it's likely to lead to bubbles in a lot of financial markets.
Thank you. Perfect.
I'd love a European car, but I've zero interest in paying too much for one. If you're the same, check out Skoda's 0% comparison rate on all new MY12, Yeti, Superb and Octavia models. Hurry, offer ends soon.
Skoda, simply clever.
At Sage, we have over 6 million customers, and that makes us a leading global supplier of business management solutions for companies with up to 1,000 employees. Like Sage CRM, our web-based business process and sales management solution, tightly integrated with our ERP products and deployable on-premise or in the cloud. With credentials like these, we must be doing something right. So call us on 13 Sage.
Time for a new look? Turn on the style with the Goddess Waves from VS Sassoon. Conditioning steam locks in moisture, gorgeous beachy waves, high intensity shine. Turn up the volume, turn on the waves. New from VS Sassoon.
Welcome back. I'm Mark Todd from FIIG Securities. On the panel tonight we have Christopher Joy, who is an AFR columnist and YBR Funds Management Director, and Matthew Kidman, who's an ex-fund manager and a columnist with the Fairfax Publications. If you have any questions, please call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Matthew, I want to get your take on the stockbroker in general. So a lot of the viewers will have a stockbroker that their preference, Macquarie Bank or Ords or whomever. Yep. I would have thought it was very tough over the last 3 or 4 years. It's now got a little bit better. But what does it look like 2 or 3 years from now in terms of that industry, those people offering services?
Well, it's unusual. Normally you have a bounce out of a lull like we did. It started in June 2012. Yep. Now, correct me if I'm wrong, but somewhere around 25% higher some 8 or 9 months later. And I would say that it's been the most uncelebrated bull market in history, just about. Everyone's still complaining. And that's fair enough in some way. Volumes have picked up. There have been good and average months, but generally it's got a bit better. What actually hasn't happened for the stockbroker is the corporate fees. Right. So a stockbroker normally transacts for its clients, that keeps the doors open, pays for the rent, pays for the day-to-day. But the real money is made when you can do a float, a capital raising, advise on a corporate deal, because you get a percentage and it's cream. And that hasn't really come through. There's little bits and pieces, but nowhere near what it would in previous cycles. So that's where we are today. The model is changing, and the model is fees are being crunched on transactions. People are paying less for that, even though volumes for individual trades are probably going up. We've got a lot more transactions done electronically, so the advice level has come down to a degree. But what's happening, and I think the future for stockbrokers is they're changing their model, and especially retail brokers, they're trying to develop the funds management model. So you've got a client that might have $2 million or $500,000, and instead of getting a transaction fee for that, they'll still try and take that, but they'll say, well, why don't I look after your $500,000 on a discretion basis, and I'll add some other features. I'll give you asset allocation, I'll give you some tax advice even, and I want to get 1% or 1.5% on that. So they're getting the fee on the funds under advice, which, and you know, financial advisors are going down that path. Now, whether it's sustainable, I don't know, but that's where most people see the future, and that's where they're evolving. Now, if you get it right, and there's some brokers I know who have been doing that for years, they're doing very well at the moment, because it takes out the volatility to a large degree, where transactions can be great one year, disappear the next, and when they disappear, normally people want a discount right at the wrong time. So I think that's where it's heading.
Right, and what do you think?
Just quickly, I mean, it's a very interesting point you make, Matthew, because it's almost like the Empire Strikes Back. Because for 20, 30 years, we've had the institutional fund managers who have been absolutely crushing the commissions that your bog-standard stockbroker would normally earn. And it is true, I'm seeing it as well, that brokers are moving back up the value chain. They're saying, don't go to a fund manager, don't invest in a unit trust. Let me manage your money directly, a little bit like what FIIG does with bonds. You have direct see-through, you own those assets yourself, you can manage your tax liabilities flexibly. Now, obviously, the question, the risk here is that particular broker equipped with the same skill as a professional money manager? Often they aren't, but, you know, I think it's a positive development. The other thing I'd quickly say about stockbroking is I think there's more segregation in the market. So there are the comsecs and the folks that want to go direct. There are the institutional guys that do it themselves. But my mum has a broker who's great at FIIG Securities, and she uses...
You want to give the website as well there, mate?
FIIG Securities.
Yeah, thank you,
no, but he just provides her with immense convenience. And so I always see a role for the brokers. But good
I agree. I think you've got to tailor to your client, and there's going to be more niches, and there are going to be several different models. But a good stockbroker's still got a lot of value, I think.
There's no doubt.
And there's an example of it.
I mean, clearly we've got a fixed income bias on the show. It's the bond show, so everyone tells me. How do the stockbrokers get into the bond market, or do they just decide they never want to do that? Is that something that...
Can I just quickly answer that, because it's hybrids of the Trojan horse. So viewers might have heard of this term, hybrids. These are basically quasi-debt, quasi-equity instruments. The banks are issuing loads of them, billions and billions of dollars with the so-called convertible preference shares. Suncorp just listed a $750 million new-style subordinated bond that has hybrid qualities. And the brokers... So the answer to the question is the bonds are getting listed on the share market. And now stockbrokers can sell bonds just like you guys do in the wholesale market.
Right. And I would say that's the only real way. A stockbroker who's done equities, doesn't really know fixed interest. Yeah. And that will be a hard bridge to build and walk over. But there's going to be more listed instruments, like you say, because it's available and people like it listed. and that is probably where they meet in the middle somewhere.
And the key is that if it's listed on the ASX, it's divisible. So you can buy $1,000 of a bond as opposed to the minimum $500,000 threshold that, you know, say for the likes of FIIG, is otherwise an insurmountable obstacle.
That's right. And if you come to FIIG, you can get the segmented bonds, so it works quite well for all the investors. And I think the goal is to try and always segment as much as you can so they can get a balanced portfolio. So I can get all that. It's just surprising to me that, to your point, they've been very unhappy, the stockbroking fraternity. It just hasn't translated into the broader market. And I think it's a GFC fight back, in that the clients are now much more aggressive about their fees.
Of course. And that's the way it works. That's the way it works. But the irony is the fund manager, who has had a pretty good year and a half, probably. Yep. The broker hasn't come with him. He hasn't been invited to the party. No. But the stockbroker is still getting a crunch on the fee. So it'll come back. It'll be there, because once the corporate deals come, the gatekeeper to the corporate deals is the stockbroker.
Once it's moved out. Once that money's moved out into the broader market, then we can get some equity raisings, and that'll be more popular.
That's right, and the stockbroker has a lot more power in that relationship.
Yep, and the driver of this moving out is the QE forever. So let's talk about QE 3, 4 and 5, the way it goes on. How do you unwind this thing? Chris, have you got a thought on how they're going to unwind QE forever?
Well, I think viewers need to understand that, again, this is government saying they disagree with the prices they're seeing in financial markets, and they want to make those prices higher. So they want bond prices to be higher, and now they want equity prices to be high, because they want debt to be cheaper and equity to be cheaper. But it's just not sustainable, and eventually it does have to end. I think it'll run probably longer and harder than most anticipate, because everything's peachy, you know, whilst it's happening. But when it does end, I think it's going to be pretty ugly, and the ultimate result will undeniably be higher interest rates, lower equity values, and cash and floating rate debt will, I think, be a safe harbour in that scenario.
How do we unwind it? How do we end it?
I think Japan just naturally falls into a hole. So is they're one of the QE exponents, which we know they invented the concept. They've just ramped it up dramatically recently. So I just don't think they've got any way out. However, so you look to the US, I think there's a real fight going on in the Fed now.
Yep.
You know, the conversation's changed in the last 3 or 4 months about maybe we unwind, maybe we don't. And so there's a fight. And Bernanke started to drop a few hints that maybe we extend the duration. And we, you know, he's got all this.
2015.
I think they've got to do something dramatic, because what they can't do is reverse what they've done. Otherwise, the world's in a lot of pain.
And I talk to the viewers about the fact that once they start showing some sign of weakness, the hedge funds, everyone will get into the US and they will make some dramatic pain.
I don't know about that. I'm not quite sure. There's been a lot of threats about the Fed, and the Fed's won every battle to today.
But in terms of that shorting perspective, you know, they did it with gold, they got into it, they can take control. I think if Bernanke shows any weakness in that he's trying to move himself out, they will assist him moving out. If they start to say, I want to sell the long end of the curve.
The point is that the developed world is disintermediating private capital. So governments are buying private assets, be it equities or bonds, and they're crowding out private capital. It's not sustainable. Once it stops, I think you're absolutely right. I think you will see a very dramatic change, just as we have with gold prices, in asset prices, because effectively an enormous amount of demand will disappear. That is, the demand provided by states will disappear from the market.
And it's literally everywhere, isn't it? It's in Europe, it's in Japan, it's in North America, so it'll be quite wild.
It's in our home loans. I mean, it is all pervasive, the way this is percolating through the global economy.
Yeah, which is quite amazing. I mean, Bernanke got it right, and he said, move that long bond down, move the mortgage rate in the States down lower, because the problem started in the housing, and it's going to end in the housing, so I'm going to get the housing market to be stimulated. But at some time, he must wake up at 3 o'clock.
But the housing market is stimulated in the US.
That's right.
It's on its way.
It's definitely on its way.
And it's not helping the broader economy. It is in its pocket, which used to be the lead indicator and the driver of the US economy. But it's not. The money's not going out that was there. And I think the objective, obviously, is to keep rates as low as possible, because we all know if the Japanese get their inflation rate to 2%, and their bonds go to 2%, they can't pay it back.
Yeah, they'll never be able to fund that.
There's no easy. Whichever way you turn, there's a brick wall in front of Japan.
That's right. I know, as you say.
Who knows how they're going to solve it? But it's going to be interesting viewing.
Look, now we'll have to leave it there, and we will be back. But before we come back, we're going to start up the Speaker's Corner yet again. We've got the clock, and Matthew, you've got 30 seconds to tell us your views on something.
Thanks, Mark.
Going.
One thing that's come up over the last 2 or 3 years since the GFC is complaints about governments, both in the US, Europe and Australia. I think corporate Australia in particular has become a whinging community. We've dropped our productivity levels, and a lot of that's been blamed on government regulation. Well, the fact is the Australian corporate community was slow to move after the GFC, and they're paying for it right now.
Very good point. We'll be talking about productivity soon after the break.
I love flying. Every minute counts, huh? Sure. I bet you're thinking you wish you had more people on the ground.
Exactly. Someone who could help me in every country would be good.
I'm thinking maybe you already do.
With business bankers wherever you're doing business, no one connects Australia and Asia Pacific like ANZ.
I think I might watch a TV show.
Oh, I know a good one.
There's this island and it's got super cute kangaroos.
Bow Island has got rare kangaroos. Chevron's been developing energy here for decades.
We need to protect their environment.
We have a strict quarantine system to protect the integrity of the environment. 40 years on, it's still a Class A nature reserve.
It's our job to look after them.
It's my job to look after it.
When you're suffering with the aches, pains and congestion of cold and flu, it can be a real struggle. Now there's a Nurofen that targets cold and flu. Its dual action works with your body to target aches and pains for up to 8 hours and helps clear nasal congestion. So to get on with your day, trust the dual action of Nurofen Cold and Flu.
Welcome back. It's bonds versus equities, and it's your money, your call. If you have any questions about bonds or equities, please call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. Gentlemen, I just want to talk about the GDP numbers. The fact that I think anecdotally we all think the economies of the world are quite soft. Whether it be the United States or whether it be Europe is structurally soft. In Japan, we've just said it's in a hole. And Australia seems to be going through, the numbers look solid, but it feels like it's weak. How do you see the growth? Who's the engine? Which is the growth engine in the world, if there is one? China seems to be going through a disconnect. And if there's no growth engine, is that what pulls the equity market back?
Well, it's the irony, isn't it? If there's no growth, we're going to have more money printed. And so the story goes. So it's quite interesting. I would say that there is a point in time, and I don't know the day of reckoning, but I would say it's within the next 12 months, that if growth doesn't fire, then you would start to think that the US... I think Europe, we already know that it's an incredibly long period of pain. But with the US, which is the driver of the world economy still, I think we'll start to think that maybe the QE has been... lost on the real economy. Not lost on assets, but lost on the real economy. If you can't get out of that look, if I told you 5 years ago the Fed's going to put interest rates at zero and print money, you would say the economy is going to grow at 8% and there's going to be inflation.
That money's got to go into the rest of the economy. The bank's going to take it, they're going to hand it, and they just haven't done it.
It's over 4 years of it now.
And it's now being built with a lettuce leaf. It's stopped having the effect, and everyone knows that this is what's supposed to happen. It'll stop having the effect, and at some point in time, it has an effect, and it's in the form of inflation. It just becomes, this money's now worthless. To see with that. And just on China, before Chris has a go, my suspicion is that China's growth has slowed a lot quicker than what people think. They're finding the transition from a capital investment intensive country to a more balanced one, with obviously the consumer playing more of a role. I think that's really, really struggling, and we're not getting, as always in China, the numbers are hard to believe at times, but the trend is softer.
and we thought it was going to get going again, but I think that's going to be a pretty soft year for China.
And Chris, that's nothing against the China because they just put Altona. So your interpretation of GDP?
Yeah, I think what people forget is that Europe and the US are actually not that important for global growth. 60% of global growth, over 60% of global growth, comes from the developing world that we talk a lot less about. And the developing world is going to be most important for Australian growth. I think right now we're seeing a lot of partial leading indicators that suggest financial conditions in Australia are very easy. So we have the cash rate at its lowest level in history. We have the long-term interest rates, the 3- and 10-year government bond yields, near their all-time record lows. House prices have been increasing, and I think the potential upside surprise in Australia is consumption, household spending. That accounts for 50 to 60% of overall growth. And speaking to the RBA, they actually privately believe that non-mining business investment is slightly stronger than most of the economists suggest. It'll be the last economic variable to come into play. It will need to see strong house price growth, strong consumer spending, but they do believe it will come online.
Which is a normal cycle, isn't it? The consumer goes first to pick up. I would think that that's right. And it goes back to my point just before in the 30 seconds. I think since February, and the companies I talk to, there's been a pocket, and the economy's stopped. Right. And especially, not so much the consumer. We can see the consumer still spending. House prices are easing up. Starts are easing up, which is nice. Not as aggressively as previous upticks in cycles, but going the right direction. But even though on very low rates, but spending between companies has dropped away. We talked about the banks, you talked about any IT services business, you talked to transport companies, they've said they've seen a noticeable drop-off in business since February. So I think we have slowed, and I think we will get more interest rate cuts, whether it's before the budget or after. I don't think that's necessarily a great thing because at 3% we should be able to get the results we need, and probably money starts doing what it's already been done, which is chasing, equities and bonds to proportions.
I think we're going to have a de facto easing whether we like it or not. If the RBA doesn't move in May, I think it's irrelevant because I think the weight of money is coming in to the extent that interest rates just go lower naturally. But I don't think banks would pass that on. They might issue some more bonds and therefore give you better mortgage rates, but I think there's a de facto easing or risk of a de facto easing afoot. Next Tuesday, do we have a rate cut? What's your interpretation of May, June?
Yeah, so
Call on.
The financial market's pricing for next Tuesday a 56% probability of a cut. In April, after the last meeting, the chance of a May cut was only 20%, so there's been a huge increase. It's absolutely a line ball call. My sense is the RBA is pretty indifferent. They don't think that a 25 basis point cut next Tuesday will change the price of eggs in China. They definitely believe that the benign CPI print, the relatively modest inflation growth we've had, gives them room to cut. I think the risk is, because I don't think rates should fall myself, the risk is that the more dovish board members who have businesses, who have been manufacturing industry lobbyists, the Treasury Secretary, whoever the case may be, I think the risk is that they tilt the probabilities in favour of a cut either in May or June. Having said that, if we don't get one on Tuesday, so much can happen between May and June that we may revert back to the scenario we had only 3, 4, 5 weeks ago, where most economists, or a significant number of economists, thought the easing cycle was over and the next move in rates was up.
But no one really believed that. That was just trying to fill an economist's piece of paper. No one really believed the rates were going to go up at the end of the year.
Well,
not
actually,
with the Fed being where they are saying, I'm at zero and I'm holding on to grim death and I'm not moving.
Mark, I'd respectfully disagree. And let me explain why. It's fascinating what's happened in the last month. The 3-year Aussie government bond yield went 20 basis points, or 0.2 percentage points, above the cash rate. So the financial market was saying that over the next 3 years, they actually expected interest rates to be at or above their current levels. So the financial market absolutely bought into that thesis for a period. But guess what? Today, the 3-year government bond yield is back around 2.5%. So the financial market has swung back in favour of cuts.
And I'll rebut your argument around this line. I've worked in financial markets since '85. I wouldn't trust those guys. They're looking to punt. They start at 8:30, they finish at 4:30, and they want to be square, and they want to push rates wherever they can to make it $1. That's what they...
So if you don't trust the economists, you don't trust the traders, who do you trust?
Man in the street. He'll tell me that it's going really well or really bad, and I think sometimes the anecdotal evidence feels so much better. That gut sometimes works quite well.
Yeah.
And I talked to a very big property developer the other week, and he said, I am really struggling on rentals. I'm really struggling to get, when I go to big IT companies and say, here's a good space, here's a nice, huge floor you can take, they say, yep, we're going to do it, and then the approval comes from offshore and it says no.
So
and everyone is getting
commercial renters.
They're commercial renters, yeah. And when they turn to their offshore parent and say, I've got a great deal, this is really good, the offshore parent is saying no, and this developer, and I'm talking a really big developer, he's saying it is really hard at the moment. And you know, that has to feed out into the man in the street who's got the fish and chip shop or the newsagents.
But developers aren't like fund managers. It's always very difficult.
I agree. I reckon there are too many rent seekers.
No, on the percentage, Mark, I think we're somewhere between 80 and 90% chance May or June. If we put them together, we'll get one cut.
And for what it's worth, financial markets are saying there's a 100% chance of a cut by June.
We know what we think of financial markets. I've worked in it for too long. We'll have to go to another short break, but please give us a call, 1300 30 34 35, or email yourmoney@skynews.com.au, and we'll be right back.
Time for a new look? Turn on the style with the Goddess Waves from VS Sassoon. Conditioning steam locks in moisture, gorgeous beachy waves, high intensity shine. Turn up the volume, turn on the waves. New from VS Sassoon.
Hello shoppers, I'm Barry Morgan. Now my life hasn't always been prawn cocktails and gherkin chips, you know, but Crazy Domain's made all my interweb dreams come true.
It's only a crazy idea until you make it happen with Crazy Domains.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined by Christopher Joy, the AFR columnist and YBR Funds Management Director, and Matthew Kidman, who's an ex-fund manager and a columnist with the Fairfax Publications. They're here to answer your questions, so please call on 1300 30 34 35 or email. Email is yourmoney@skynews.com.au. Chris, we talked about the cash rate before we went. How is the YBR Funds Management, the cash rate, the cash fund going? Sure. It's been challenging times to some extent, hasn't it? Because if you're trying to have a cash fund, it's always hard. I think it's not sexy. So
yeah, I think cash is an interesting place. So YBR Funds Management has an active cash fund called Smarter Money. It was launched over a year ago. The team's done very well. Basically, it invests in bank deposits and bank bonds, all in Australia, yep. All investment grade, and only variable rate, so it takes no interest rate risk in that regard. They've managed to deliver about 3% after fees above the RBA cash rate, or 300 basis points, actually 300 to 400 basis points over. So it's been fantastic in a period in which actually the RBA cash rate's been falling. It's among the top-ranked funds in the Morningstar universe. But cash is, as you say, it's not a particularly sexy place. And I think one of the interesting dynamics, further to what we were saying earlier, is that if the RBA does cut again, I think that's going to be yet another key inflection point for mums and dads and consumers who will be looking at their bank deposits and saying, I just am not getting the income I need to survive, or that is acceptable to me given my return expectations, which means they're going to go into high-risk bonds or equities or other areas.
Jade, I think we've got a chart there of Chris's fund, and so I think there's a, it's a pretty stellar chart, isn't it? There's a nice big fat gap. That's one that you'd want to show to the investors and say this is how it's supposed to work. But you're right. If you can get that number above the cash rate, the RBA cash rate, it eats into the inflation piece. It takes away the inflation risk, which is, let's say, it's 2 to 2.5%, and it's an actual real return. Whereas you see a lot of investors thinking, I got 4%, that's okay, but when they take out inflation, it's not so okay. it becomes a little bit...
I think in cash what you haven't seen is much active management. So, you know, the team works with, you know, folks like you guys, FIIG, to try and hunt out the best rates on institutionally negotiated deposits, but also the best yields on bank bonds. And I think in fixed income historically has been Sleepy Hollow. The smartest guys who have received the highest fees have been working in equities and hedge funds, and the bond guys have been poorly paid, and they've been a little bit more sort of, you know, modest in their aspirations. So hopefully that product has a role to play.
I remind my boss I'm poorly paid and he ignores me. He becomes deaf, tone deaf. He wants more productivity, and let's talk about that. I think you're right. We were talking about this today. The idea that productivity has somehow morphed into something other than what it used to be. Apple is a productive piece, the internet's a productive piece. Productivity right now, when I talk to people in banking, it's I've missed the productivity piece. And I said, what's that mean? He said, I've still got a job. You know, the idea around productivity has been you work longer for less and I'm going to get rid of your friend. You know, so that seems to have been the way people now view productivity. But how do you imagine we're going to get back into the productivity sphere?
Yeah.
Well, the
problem with productivity, so Australia's fallen behind the benchmark, which is the US. If you look up, we've dropped, I think, about 11% against the US in the last decade, so we're 11% less productive against them. Right. And that's not great. But you look at the US, their rate of productivity increases, so they're still increasing, but has dropped down. Now, you get a kick, as you say, there is one form of productivity, is that in a recession or downturn, sure, you cut staff and you work longer hours and the output, which is measuring the productivity, from a unit of labour goes up. But to get sustainable productivity, you need investment, you need technological change, you need to have outgoing up at a regular basis or you know, at a faster rate than your cost base. And that has really waned the last couple of years, and I think it's to do with the fact that money is not finding the place that it used to be, reinvestment. Now, we talk about Apple, and really we're talking about smart devices. There's a great piece in the Wall Street Journal the other day which was talking about economists can't find the productivity being generated by our smartphones, even though we know there's a whole bunch of applications and projects and whatnot within those devices that help us do business better and more efficiently. It's not getting anywhere else. So I think there's a big gap in productivity, and why I bring it up is for stock markets in particular, which I'm interested in. Productivity, when productivity has been at its highest growth, that's when markets charge, because you get better earnings without inflation. Yeah. And that's the ideal scenario.
So for me,
Chris, what's your thoughts on that?
Yeah, I mean, I think productivity is about doing business better. It is about, you know, more flexible labour markets. It's about working harder. But really, the centrepiece of productivity is ingenuity and innovation. And what that means is creating new businesses. And I think there are missing markets for entrepreneurs who are trying to raise equity capital or debt capital, and they cannot get the finance. It's extremely hard to raise venture capital, and banks won't lend to you, and they certainly won't lend to you at reasonable rates in large volumes if you're starting a new business. And so government policy does have a role to play to encourage entrepreneurship, and it disappoints me when I see, you know, hundreds of millions of dollars of subsidies out there for, you know, Baz Luhrmann and his feature films that he's making here in Australia. And we don't have enough, I think, focus on the tax incentives we can give for people who are out there trying to start new businesses.
I think the other thing is where a government can play a role, and I don't want to say government's got the big role to do, because it does in the private sector as well. Governments, we need, and especially in Australia, Chris was struggling to get out here, traffic, whatnot. Australia's not a populous place. We've got poor infrastructure. Yeah, we could do things a lot better here. We could be a lot more productive. And because of the financial situation around the world, everyone's tightened their belts and all these different things. We've actually got to start spending on and realign our spending to get things done that make us more efficient.
I could not agree more. I think if Warren Buffett had our budget, he'd say, let's go and issue some debt because it is so cheap. Let's go and borrow at 2.5% and let's go and build. For 30 years. That's for 30 years. Let's do a 30-year bond and let's go and build whatever we need, whether it be infrastructure within Sydney, Brisbane, whatever corridor you need to do. I mean, I like the narrative of the NBN as an infrastructure story, and I think completely badly executed. They can't execute any story, so the narrative is terrible in what they do. But
the idea is a good one.
It's a great idea, and being able to get the two parties together and say, at this point in time, we need to have a proper narrative around infrastructure. We need to say a Snowy Mountains hydro. We need to say, let's do a, you know, whatever, an Opera House bond. whatever you need to have, so the people are embedded in it. They are embedded in the initiative. I think that the country's crying out for that sort of stuff.
Well, if you didn't have the Great Depression, you would have never built the Sydney Harbour Bridge when they did.
Correct.
And look at what it's achieved. It's actually brought two cities together, even though it chokes these days. But at the time...
I'll just add one comment to the infrastructure debate. I also agree wholeheartedly that there's a massive infrastructure deficit. I think people are becoming increasingly aware of it. I'm not so sure, though, the answer is debt. I think the tough piece in the capital structure to raise for infrastructure is actually equity. My proposal that I put out there a few years ago was just make qualifying national infrastructure projects completely tax exempt. So then you'll get the super funds and the private capital providing the equity. You'll get the bonds as well. But if you provide tax incentives to direct rational, thoughtful capital into infrastructure projects, we'll get more money heading in that direction.
There's a lot of capital up front, revenue trailing behind.
Yeah,
so
it's the equity piece. Is
it's a hard
and
one.
you look at IFM, you know, it's a 44 billion, colossus, and it's always looking for some infrastructure assets. They aren't buying it, all the airports they can find. And you think if you created the right structure and said, okay, there's the money, now let's have an agreement on what the structure is.
We've got a lot of super coming on board too, which we've talked about before. You've got to get the right structure and the right tax incentives. You're 100% right.
Which would have the right political narrative, which I don't know if either side of the politics have got those skill sets.
I actually have great faith, frankly, that Joe Hockey will man up on some of these issues.
Oh, Lord, we'll have to come back on that one.
We'll have to have a quick break, but please give us a call on 1300 30 34 35 and email us yourmoney@skynews.com.au. We'll be right back.
At Sage, we have over 6 million customers, and that makes us a leading global supplier of business management solutions for companies with up to 1,000 employees. Like Sage ERP X3, our global solution for larger businesses, with almost 4,000 customers in 58 countries worldwide, deployable on-premise or in the cloud. With credentials like these, we must be doing something right, so call us on 13 Sage.
TPG presents our Unlimited Bundle. Get unlimited ADSL2 Plus with home phone line rental. Unlimited calls to local and standard national numbers. Unlimited calls to Australian mobile numbers. And unlimited calls to selected international countries. Plus a Wi-Fi modem. All for just $79.99 a month. Yep, $79.99 a month. TPG is a multi-award winner.
tpg.com.au.
Welcome back to Bonds versus Equities, Your Money, Your Call. We're here in the last segment of the night, so if you have any questions on bonds or equities, phone 1300 30 34 35 and email yourmoney@skynews.com.au. Prior to going to the break, we had a Joe Hockey spiel. I must admit, when he put out the idea that we could have he would consider a 30-year bond curve, I thought that was a great piece. Joe Hockey would be a man amongst men to be able to get that through the Parliament, because I think the effect on the curve would be great, that people would say, we can borrow, Nike's just done a 30-year, Apple's done a 30-year, America, it's run-of-the-mill. They don't even need it. It's just a tax play.
It's an opportunity, isn't it?
It's an opportunity, and we have good corporates who could take that opportunity. BHP always goes offshore, everyone goes offshore. You could see corporates, come into the market with new issuance that we, the superannuant, would like to lend to.
Yeah, actually, Joe's I think a great guy. He's got a lot of authenticity. He's a lot tougher and smarter than I think many people presume. He used to be a corporate lawyer. He's actually got the former head of fixed income from UBS as his chief of staff. And I think he gets into trouble occasionally with that authenticity. So he'll speak his mind, and if it's not on message with the party line, he gets trapped. But I think one of the things that will be interesting about Joe, assuming he becomes our next treasurer, is I think he's going to surprise with his policy integrity. I don't think he's going to... I think we're going to see some interesting ideas. I think we'll see some innovation. And I don't think he'll necessarily take the orthodox Treasury and RBA line all the time.
It'll be interesting to see somebody with, in a political integrity piece. So that would be quite a new, paradigm. I think, I have nothing negative to say about the Gillard government, because I think it tries the best it can, and I just think it lacks some of that nuance around how to get the message right. They've got, some policies come through, they get it together, and you say, how did that happen? It sort of stumbled in, and it's definitely a very hard job for them at the moment. So, yeah,
I think
maybe
part
right.
of Joe's battle will be how he gets on with his leader. And how persuasive he is. Like all people within a party. How much say do they have? We all know when Keating came in, he had the ear of Hawke, who was smart enough to listen to him, and he convinced the rest of them. Costello probably the same, but it dwindled as time went on, and Howard became more entrenched in his position. So I think there's some reasonable brains in the Liberal coalition, but I don't know whether those economic brains extend to their leader.
Correct. Now let's not be nasty to the leader. The thing that I suppose that we look at is all the leaders of the world, in my mind, are tending to get it wrong with this austerity drive. You know, the Germans drive it, everyone's driving it. It seems to have switched a little bit now. What's your views on the austerity piece versus now the driver for growth? Is there going to be a growth narrative that'll work? Will people be able to get it together?
Clear. I mean, the alternative to austerity is more debt. And I don't think credit is a panacea for all economic problems. And I think that's the crux of this debate. I think austerity is really about working harder, saving more, deleveraging. And I think the Germans, having had the experience with hyperinflation, realise that, frankly, there are no ultimately easy answers. And that's why they've, I think, been very vigilant in trying to push through genuine reform. And I think it comes back to QE. I think, you know, we can't have a never-ending QE.
Look, we're going to have to leave it there. I think we could talk about the Germans for about a week. But that's all we have time for the show today. So I want to thank very much our guests, Christopher Joy, the AFR columnist and YBR Funds Management Director, and Matthew Kidman, who's our an ex-fund manager and a columnist with the Fairfax Publications. I'd like to say a special hello to Sheila Saul from Balmain. She's been a great supporter. Thank you for any phone calls or emails that didn't get through. Next week, Mark Todd, FIIG Securities. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.